Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to continue with our series of advanced financial management. And in our previous video, we spoke about capital market theories, and we promised that we are going to be looking at the two theories that we have. And these two theories that we talked about are the traditional theory and then the Mordigillian and Miller. And I had promised that we are going to kick off by looking at the traditional theory of capital structure, and that's what we are going to look at. So the traditional theory of capital structure. Now, if we look at the traditional theory of capital structure, the issue is all about the WACC. That is what we call the overall cost of capital. Overall cost of capital. The overall cost of capital of any company, or basically what we call the cost of capital. Because WACC is the weighted average cost of capital. So it comes from these words. W is this, A is this, C is this, then the last C. So how do we come to get this an understanding? I want to be a little bit as brief, as detailed as possible. Brief but very detailed as possible, so that you can be able to understand. It is very easy for you to understand it. Now, you know that in the business, this WACC, we compute it this WACC, or the cost of capital, is the one that we use to appraise investments. Appraise investment projects. So once we use this WACC to appraise investment projects, especially when we are using these discounted or non-discounted cash flow techniques, as we shall look at them when we do the NPV, the investment decision question. Now, how does it come about, or how best can you explain the traditional theory of capital structure? Now, this is very simple. So, if, of course, you know, when you are doing business valuation, you know that the value of a business, or a company, of course, we are looking at valuing the company. Once you are valuing the company, we all know that when you're valuing the company, the value of the company is the present value of its future cash flows. Present value of future cash flows. And when we talk about the present value of future cash flows, we are simply saying you get the discount factor, you get the cash flows that you expect to receive from a given project for the very many years. Then you discount it using the cost of capital, which we call the WACC. So we are discounting. The process we go through is what we call discounting. We discount these cash flows We discount these cash flows using WACC. That's the one that we use to discount these cash flows, or what we call the cost of capital. Now, how are we going to do it basically? Now, what happens is that since we are going to be using our WACC to discount the cash flows that we expect to receive from that investment that we are making, because when you are making an investment, you expect to be getting some money back. Maybe this year you may get 10 million. If you construct a building and it's a residential, maybe then you rent it out to tenants, you expect to be getting cash flows. That money that you are expecting to be getting is what we call the cash flow. So for us to know how much that business or that building is, we need to first discount the cash flows that you are getting from that building. Then we can know the value of that asset or of that building. That's how even what we do with business valuation. We discount the cash flows that we expect to receive for the different investment projects that we did. Then when we are done, we can be able to know the value of this company. Now, what happens if at all you increase the debt? Because remember, for you to compute WACC, you need to have the different sources that will come together for you to be able to get the cost of capital, the overall cost of capital. That is the cost of using all the sources that you are using in financing those investment projects. Now, what happens? Because within the WACC we have both debt and equity. So what is going to happen is that if you increase debt, what happens if at all you increase? If let's say you decrease, let's start with the fact that we want maybe to increase debt in our capital structure. What will happen? Now, when you increase debt, then this means that this WACC, the weighted average cost of capital, of course, it will mathematically go up. Mathematically, it will go up. The reason as why it is going to be increasing is because we have increased more debt. And once this WACC increases, of course, once we increase debt, then even the WACC is also going to increase. Now, what is the impact? Once this WACC goes up, then the overall cash flows, because it is this WACC that we are going to be using to evaluate the cash flows, then the cash flows, the overall cash flows will decrease. It will causing cash flows to decrease. They will decrease. Why? Or what happens? This, we are talking about it mathematically. Now, this is what happens. The overall cash flow will decrease because, look, when we are getting the present value, we know that when you are getting the present value, we always get the future value divided by 1 plus r to the power of n. Or the other, you may use future value into 1 plus r to the power of negative n, whichever way. But me, I prefer this. I prefer the first one. Now, what is going to happen is that we are getting the present, these are the cash flows. Now, we are getting these cash flows and we divide, this is the numerator, we divide the numerator by, of course, this is r, is what we call the WACC, the weighted average cost of capital, or the cost of capital, or the required rate of return of the business. So once this WACC has increased, it means the implication mathematically it is going to be like this numerator is going to be divided by a bigger numerator. If let's say our work was, let's say 10%, but now we go ahead and we increase our work to maybe 20%. What is going to happen is that this work has increased. If let's say we had cash flows, we were expecting cash flows of 10 million every year, fixed 10 million. What is going to happen? The amount you are going to have here will not be the same as the amount you are going to have here. So what is going to happen? If you put in your calculator and you just compute it in just 1 year, you just look at what will be the present value for just 1 year. So what is going to happen is that this is going to be 10 million divided by 1 plus 0.1 to the power of 1. So it is going to be 10 million divided by 1.1. So this is going to give you 909, of course 909. If you round off, it's going to give you 9 million. Now, what will happen if at all we increase this rate to 20%? So it will give you 10 million over 1.2. So I think that this denominator is now increasing. So what is going to happen? It is going to reduce the overall cash flow. It will be the 10 million divided by the 1.2, and this is going to give you 8.333. So this is what we are meaning. This is 8.3, this is 9.09. So the overall cash flow is going to reduce. And once the overall cash flow is reducing, remember we said this is now the present value. Once the present value has reduced, automatically the value of the business is also going to reduce. But what caused that? It was from the fact that you increased the debt in your capital structure, and that increasing debt resulted into an increase in the cost of capital. And once the cost of capital increased, it has automatically led to a lower overall cash flow that we are going to use, because these are the cash flows that we are going to sum up to know the value of the business. So automatically it will result into a reduction in the value of the company or of that asset. So that's one argument. And that's basically what these traditionalists are thinking. That's their thinking. Now, because we are going to be having cash flows going down, the resultant cash flow going down, because of us dividing the numerator, we divided it by with a bigger denominator. The result will be a lower. So once the value of the cash flows have reduced, even the value of the business is going to decrease. And that's how the traditionalists are thinking. Now, if you try to reduce, now if at all you try to reduce your debt in the capital structure, automatically it will, even the work will go down. The work will decrease. And once the work decreases, then what is the resultant figure? What is going to happen is that we are going to have the overall cash flow is going to increase. The reason as why the overall cash flow is increasing is because we are dividing a numerator by a lower denominator, and that causes the business to actually have a higher cash flow, the resultant cash flow. And once the resultant cash flow is higher, then it is also going to automatically increase the value of the business. So this, look, the present value, we say that the present value present value equal to future cash flow over the future value divided by 1 plus R to the power, let's say to the power n, but we are just going to basically look at 1 year, year 1 alone. So if we have the 10 million divided by, if the work, maybe our work was let's say 10%, and we try to reduce the work, we reduce the work now to 5%, what will happen? What will be the end result? This one is going to be 10 divided by 1.1. Of course, this one is going to give us to the power of 1. So this one is going to give us 9.0909. So this is 9.09. So what is going to happen is the fact that here we are going to have, if you try to divide this other one, when you have reduced, it will be 10 million divided by 1.05, because this is 5% when you are using the other 5%. So it is going to be the 10 million divided by 1.05. This is going to give you 9.5. Are you seeing that the overall value is reducing? 809. So the overall value for the overall cash flow is going to be increasing. And once the overall cash flow, the present value has increased, it means it has also increased the value of the business or the value of that asset you are trying to value. I hope you are getting my argument. So what are they meaning? They are meaning that for you to reduce debt in your capital structure, it's going to automatically reduce what we call the WACC of the company. And once the WACC has reduced, it will result into a higher value of the business, because you are going to be having a higher cash flow that you are going to sum up to get the total value of the business. Now, of course, once the value of the business goes up, even the shareholders are going to be happy. They are going to be happy because they are going to be receiving more money on their, even the share price is going to increase because of an increase in the value of the business. So the overall result is going to be the shareholders are going to be happy. And they are happy because you have reduced debt in your capital structure. Now, for them, in their thinking about all this kind of capital structure issue, for them, their issue is for you to have what we call a balance. You need to balance off between debt and equity. In other words, you need to trade off between debt and equity. And that's why their theory is summarized in a very brief way. For them, what they are saying is that for the traditional theory basically says, it states that work must be minimized. Work is minimized. In other words, don't keep on borrowing, because you need to minimize the work such that the value of the company or the market value of the company's assets will be maximized. So work must be minimized so that they can maximize the value of the business. And for you to minimize work, you must reduce debt. You must regulate your debt. So if you minimize work through little debt, like having little debt portion in your capital structure, then you are going to be able to give the shareholders a good return on their investment, because the value of the business will actually go up and they will have more to get for the money that they have invested in their business. Now, the traditional theory of capital structure continues to say that for any business or for any investment, there must be what we call an optimal level or optimal mix. They call it mix of debt and equity. We must have an optimal level of debt and equity. In other words, we should have a balance between the two sources of finance, the debt and the equity finance sources. Therefore, you will be able to minimize your work, and eventually the value of the company will be able to increase or will be maximized. So we don't simply invest to make money for the debt holders, but we need to make money for our very own company. And for you to be able to make money for your own company, you need to minimize debt. So the traditionalists, they conclude by saying that the optimal capital structure will occur, it will only occur when it will occur where we have the marginal cost of debt being equal to the marginal cost of equity. In other words, they are looking at a situation that for you to obtain this optimal level, you must maximize, you must be able to see that the marginal cost of debt, in other words, the cost of getting more debt should be equal to that of the marginal cost of getting an additional cost of equity. So marginal cost of equity should be equaling to the marginal cost of debt. So the word marginal in this argument means additional. If you look at marginal, it means additional, something that you are going to add on. It is an additional cost. It can be the additional cost of debt or the additional cost of equity. Therefore, at that point, they will be in what we call they will be in equilibrium. They will be in equilibrium, and work will be minimized. And when work is minimized, therefore the market value of the company will also be maximized. So if the traditionalists, for them, they conclude that if you want to really have a lot of money in the business, you should minimize the debt so that work has been minimized too, so that you can be able to get a higher figure for the value of the business. Therefore, this theory depends on the assumption that imply that the cost of either debt or equity that you are going to use in financing the business will vary with respect to the degree of leverage, or what we call gearing. Therefore, it looks at the assumption that will help you get the max. We have different assumptions, but now I feel like that I should try, because I've been a little bit mathematical when I'm trying to explain. But if you want to illustrate it graphically, we can have some small tip on how we can illustrate graphically. We get a detailed, you can use, if you don't want to go the other way around, you can go this way around, which is a little bit theoretical, and you'll find yourself drawing some graph. Now, for better explanation of the traditional theory, it is better for you to use a graph to explain it. If you don't understand the other mathematical point of view, it's better for you to explain it with a graph, where you'll first draw the graph, and of course on the horizontal, of course this, let's assume that's our graph. Then on the horizontal, of course on the horizontal we are going to have, on the horizontal we are going to have the level of gearing. Then on the vertical, of course on the vertical we are going to have the cost of capital. Cost of the capital, let me just call it WACC. WACC. Now, so that's how we are going to be able to draw this. Now, as you have heard from the explanation that I've made, what you need to do, you need to minimize WACC. In order for you to minimize WACC, you will need to reduce debt. By reducing debt, it will result into maximizing the value of the company. And in order for you to be able to have that higher value of the business, as I said, the first thing you do, you have to minimize to minimize WACC, and at the same time you minimize the level of debt. So the level of debt must be minimized at the optimal level. At the optimal, meaning it shouldn't be lower, it shouldn't be higher, at the optimal. So they are saying that as you keep on borrowing, the cost of equity will keep on rising. So this percentage will actually be a percentage of WACC, or cost of capital. This is in a percentage, it will be in a percentage form. Now, this is how the graph is going to look like. We can start from some point. Maybe we take it that way. Then we draw something that is a bit going down like that. Now, we shall have what we call the minimum point here. This is the optimal gearing. Optimal gearing, whereby you are not all that geared and you are not all that. So this is the equilibrium. This is the equilibrium point, or the optimal point. So once you go this side, you are increasing. So here we are increasing WACC. It will be an increase in WACC. Of course, this is a WACC line. This one is a WACC line. And this one is the cost of equity. This is cost of equity. Cost of equity. So once you keep on increasing this, of course here we try to minimize by moving downwards. So this is, here we are minimizing. By moving down, we are trying to minimize WACC to the optimal. To the optimal point. Of course, this is now the optimal point. So I want to explain. Now, the whole portion, for sure, for debt, the one for debt, we want to keep it lower. We want to keep it below. So we can keep it maybe somewhere here to be a little bit constant. And we say this is our debt. So this is the debt, the cost of debt. This is equity. So it is going to be from this point, then from here. Now, remember these are percentages. What we are trying to do is we are trying to make sure. So once the other thing that I need you to note is this point here, we have the minimum. So once you go this side, you are going to be highly geared. And the moment you keep going this side, you are not going to be geared. So once you proceed to this side, you are increasing. Remember, at this point here, we have our optimal rate. WACC has been fixed to this point. But the moment you keep on adjusting and you add in, maybe you try to increase, you are moving out from the optimal level, you will see that even the percentage will keep on increasing. The more you do that, it will keep on increasing. And that's what we don't want. So that's why we are saying we are interested in us minimizing, moving a little bit, we reduce debt to a certain point here. That is the equilibrium point or the optimal point. And at this point, we expect that at this rate, the WACC is going to be reduced. Because by reducing debt here, you are lowering the WACC to this point. It was here, but you are lowering it to that point. That means that you are going to be having a lot of debt. So you are going to be having, the debt will be reduced because it will be down below. We keep it. Of course, this one you can ignore it or you can just put it if you want. But that's how the graph will be looking like. Now, so in order for us to be able to minimize WACC, the level of debt must be reduced to the optimal point. So the whole of this line here that you are seeing is going to be our debt. Now, once you reduce the level of debt to the minimum point, so what we are saying is that as you keep on borrowing, the cost of equity will keep on increasing. For you, the more you keep on borrowing like this, the cost of equity for it is going to be increasing, as you are seeing. It's a little bit constant. Now, so what we do, we start to reduce debt downwards. So as you borrow, you will be like, you will keep on paying interest on debt, and the owners, of course, they are going to be demanding more because you are paying the other side, and for them you are not paying them, because interest is going to be paid whether you want it or you don't want, even if you don't make profit. So as you keep on borrowing, the cost of equity keeps on going up. But the WACC, of course, the WACC will of course initially drops. It will drop to a certain point as the level of debt has also increased beyond that point. And finally, the WACC will be going up, meaning that the value of the company will be also reducing. So the traditionalists are just proposing that to balance between the two, we have to have an optimal level of gearing. And those are the things that I was trying to explain in the first mathematical approach that I used. So what is the implication? Maybe before we look at the implication, let's first just give out the assumptions, just stating the assumptions. The assumptions, of course, we have, they assume that the company will pay all its earnings as dividends. The company will pay all its earnings as dividends. They also assume that the gearing of the company can be changed immediately by of course using debt to repurchase the shares, or by increasing the shares to repurchase debt. Once you increase the shares, you buy off the other people. You get more shares, then you pay off your loan. It's like you are repurchasing the debt. Therefore, that you will not have something to do with the transaction costs. They are also assuming that the earnings of the company are expected to remain constant in perpetuity, and that all investors share the same expectation about the future earnings, which is not the case. They are also saying that the business risks are constant, regardless of how the company investment or the company investors are, or investment and its fund. They are also ignoring the aspects of taxation. So we have no taxation. They are saying business risks are constant, and others. So we now want to look at what is the implication of this. Implications, depending on the graph that we drew. So since a company is going to always wish to be borrowing cheaper. So since the company is going to be wishing to borrow in the cheapest way possible, then it should raise debt finance until it achieves the optimal level of gearing. So for them, they are worried that we don't keep on borrowing and borrowing, and you should borrow up to a certain point, and beyond that, it will be a problem to the business.